Hello everyone, welcome back to the channel. Today we are going to discuss the structure of the insurance policy. Insurance contracts were traditionally written on the basis of every single type of risk, where the risks were defined extreme narrowly, and the separate premium was calculated and the charged for ones for each. Only those individual risks expressly described as schedule in the policy were covered. Hence these policies are now described as the individual or schedule policy. The system of name perils covered moved in unsustainable in the context and the second industrial revolutions. In the typical large correlate might be have a dozen of types of risk in to insure against. For example, in 1926, an insurance industry spokesman noted that the bakery would have to buy a separate policy for each of the following risks: manufacturing operations, elevators, and teamsters, product liability, and conduct liability. For a sport truck connecting to a bakery to a nearby railway road to a near railroad, and premises liability for retail stores, and the owner protective liability for the negligence of contractor hired to make any building modification. In 1901, the insurance industry began to shift the current system where covered risk and initially define broadly in all risk and all sums. Insurance agreement on general policy will pay all sums that insurance become legally obtained to pay as such as damage, and then narrowed down by subjection exclusions clause, and this insurance does not apply to something. If the insurance desires cover for a risk taken out by an exclusion on the standard form, the insurance can be sometime pay an additional premium for the endorsement to policy that overrides the exclusions. And if we explain the another part of that, the parts of an insurance contract. So here the part of insurance contract, and declarations identify who's insured and the insured addresses and the insuring company, what risk or property are covered, the policy limits, amount of insurance, and any applicable deductibilities, and the policy numbers, the policy periods, the policy numbers and the policy periods, and the premiums. And these are usually provided on the form that is filled out by the insurer based on the insured application and attached on the top of inserted with a few pages of a policy. And the definition defines an important terms used as the policy, and insuring agreements describe the covered perils and risk assumed, or a nature of a coverage. There, this is where the insurance company makes one or more expenses to indemnify the insured. And there is a lot of another explanation of insurance policy. Basically, in simple words, you can say, if you have some extra money and you want to put that in a good investments where you can get this investment back, you can put in on your life. For example, if you pay in a premium of $500 or $200 or $300 every month, and if you say, if I died in next 30 years, you will pay my kids $1 million, $250,000. That is what is real policy. People pay that, and if they have some extra money and they play that game for making their kids rich, that is what actually insurance policy people use in United States of America. And if you want to take the benefit of it, you have to carefully read the policies of that insured company, because they are very, very, very bad peoples, and they're gonna blast you. Okay, so you have to read the agreements very carefully, and after that you have to sign on it. And believe me, if it will go the way that you want, you will be a millionaire in 5 to 10 years.